Welcome to the Pirls Stock Market Commentary video, your weekly window on stock market technical conditions, featuring the proprietary bull-bear point and figure market breadth summary chart for July 1st, 2018. Market breadth. With this past week's market advance, our bull-bear point and figure ratio at 0.82 fell from 1.05 last week, declining into bearish territory. The total count of securities in bullish or bearish patterns increased 2% to 2,994. The count of bearish stocks increased 15%, while the count of stocks in bullish patterns decreased 11%. The Sand to Pearls PNF Market Breadth Summary Chart shows us a market now 1 week in bearish territory. Paid subscribers have access to the Open Office Calc data from which the chart is generated. You may become a paid subscriber by visiting s2pmarketsignal.com, clicking Membership, clicking Register, and following the prompts. To receive the weekly Sand to Pearls Stock Market Commentary via email, free of charge, simply enter your name and your email address in the spaces provided and click Subscribe. The well-known market breadth indicator, the Nasdaq McClellan Summation Index, fell 215 points for the second decline in 3 weeks. At a positive 300.78 points, it has fallen below the January 2018, the February 2017, December 2016, July 2016, and May 2016 highs. It continues above the March 2018 and July 2017 tops, above plus 100 in the last 30 months, and it continues above all 4 bottoms below minus 100 in the last 30 months. Volume analysis. In this week's volume analysis, the Nasdaq Composite Index ended in neither accumulation nor distribution mode, with average daily volume lower than the prior week. In the last 2 weeks, the Nasdaq had 1 accumulation day and 4 distribution days. Accumulation days are counted when the index closes up on higher volume than the prior market day, while distribution days occur when the index closes down on volume higher than the prior market day. Last week, the Nasdaq ended in distribution mode on higher average daily volume. Momentum. The CCI 20 daily at a negative 110.75 is down from a positive 51.99 last week. We continue to wait for the CCI 20 daily to return within the plus or minus 50 range for another valid zero-line reject long entry signal. There are currently 5 consecutive days below zero for a likely change of Woody's CCI 20 daily trend at Monday 7/2 close. In Woody's CCI trading system, 6 consecutive bars above or below zero are required for a change of trend. The weekly CCI 20 of the Nasdaq Composite Index began a Woody's uptrend 113 weeks ago, while the daily CCI 20 began a Woody's uptrend 10 weeks ago. The CCI 20 weekly fell to a positive 68.44 from a positive 139.11 last week, continuing outside the plus or minus 50 range required for a valid zero-line reject long entry signal. Industry rotation the last 2 weeks. All of the top 5 industries are positive, and all of the bottom 5 are negative. Summary: REITs and oil on top, semis, brokers, and some tech on the bottom. Bullish: REITs continues in the top 5. Bearish: computer hardware, semis, and brokers continue in the bottom 5. Disk drives has entered the bottom 5. S&P Retail has left the top 5. Oil has left the bottom 5 and entered the top 5. Oil services has entered the top 5. Focus this week from www.dollarcollapse.com. Emerging market crisis spreads to the core. Central banks face catch-22. The following are some key points and charts. One of the things giving, quote, data-driven, end quote, central banks wiggle room on their pledge to tighten monetary policy is the fact there are several definitions of inflation. In the U.S., the thing most people think of as inflation is the Consumer Price Index, or CPI, which is now running comfortably above the Fed's target. But the Fed prefers the Personal Consumption Expenditures Price Index, which tends to paint a less inflationary picture. And within the PCE universe, core PCE, which strips out energy and food, is the data series that actually motivates Fed action. And that, at long last, is now above the 2% target, having risen 2.3% in the last year. On the following chart, the core PCE is the blue line. Note the steepening slope toward mid-year. This is clearly a trend with some momentum which, if it continues, will take this index from slightly above target to substantially above. A more surprising above target reading just came from Germany, which didn't used to have inflation of any kind, but now it does. Reuters, German inflation surpassed the target set by the European Central Bank for the Eurozone in June, the second month in a row it has done so, lending support to the ECB's decision to close its bond purchase scheme at the end of the year. Data published by the Federal Statistics Office on Thursday showed that EU harmonized German consumer prices rose 2.1% year on year. The same measure had increased by 2.2% in May. The yearly figure matched a Reuters forecast. Again, note the pop over the last couple of months. If this is sustained, the European Central Bank will have to speed up its leisurely tightening pace. Right now, it's scaling back its bond buying, but not signaling higher rates, which will definitely have to be on the menu if German inflation stays above 2%. Emerging market crisis. But there's a tricky dynamic now in play. Higher interest rates and rising currencies in the core of the global financial system cause trouble on the periphery, which then boomerangs right back to the core. A bunch of Asian emerging market currencies fell 3% to 6%. Europe's emerging markets weren't spared. The Hungarian forint, Polish zloty, and Czech koruna led a long list of EU peripheral currency losers. China's stock indexes fell by double-digit percentages in the quarter, though that might have more to do with the incipient trade war. Last, but definitely not least scary, U.S. and European bank stocks fell hard last week, which isn't surprising since they're on the hook for untold amounts of the aforementioned emerging market securities and currencies. Now, all of this might blow over in coming months the way so many other mini crises have since the beginning of the great monetary experiment in 2009. But if central banks keep tightening in the face of all this carnage, it might blow up instead of over. Put another way, stopping the current slide toward financial chaos might require a quick about-face by major central banks toward lower rather than higher interest rates, expanding rather than contracting balance sheets, etc., which is a bit of a catch-22. The peripheral crisis will keep moving toward the core unless stopped by massive central bank ease. But given the rising inflation now being reported, central banks won't switch back to massive ease unless the peripheral crisis moves much closer to the core, or something else equally terrifying happens first. The resolution or lack thereof won't be long in coming. Thank you for watching this week's Sand to Pirls Stock Market Commentary video featuring the proprietary Bull-Bear Point and Figure Market Breadth Summary Chart compiled by Donald Pearl, www.s2pmarketsignal.com. Hoping that you are enjoying a peaceful and pleasant weekend, that you are looking forward to a prosperous and productive week coming up, wishing you happy Independence Week, and wishing you true success.